Okay, thanks. It's a really great honor to be able to address such a distinguished conference, although I suppose I wouldn't have chosen to be at the very end of such a packed day if I were. Um, so the theme of the announced theme of the session was both conventional and unconventional policy, which covers a lot of ground, and so I had to pick some theme from that I thought I could say something about in 25 minutes. And what I've chosen to focus on is the question of how our way of thinking about monetary stabilization policy should be different in an environment in which interest rates have been very low and are expected by many people to perhaps continue to be chronically very low, given the existence of a lower bound on what central banks can do with short-term interest rates. So the crisis of a decade ago resulted in a number of pretty substantial changes in the way central banks were approaching monetary stabilization policy, at least how they've been talking about it and thinking about it over the last decade. In the period, the couple of decades right before that, the so-called Great Moderation period, there had been a certain amount of convergence in thinking among the leading central banks on an approach in which it was typical for monetary policy decisions to be, first of all, focused exclusively on really one decision, which was choosing an operating target for some short-term nominal interest rate, typically an overnight interest rate. The target for this was also something that was decided only on a meeting-by-meeting basis without commitments in advance. In the case of most of the central banks, or at least over most of this period, there would only be discussion of the operating target to adopt until the next meeting. A few central banks, like the Reichsbank, late in this period that I'm talking about, had innovated with a procedure in which they would actually talk about a forward path for the policy rate and reveal their current thinking about the forward path of the policy rate at these meetings, but it was still a decision made on a meeting-by-meeting basis. There wasn't a decision about a path for the policy rate that was then followed over time or on a rule for setting the policy rate. It was still something that was discussed again on a meeting-by-meeting basis. That doesn't mean there was no strategy that was discussed, but discussions of the strategy of policy that people could expect the central bank to be following in the future were instead couched in terms of central banks' targets, particularly for inflation, but to some extent stabilization goals for other aggregate variables as well, under what were called flexible inflation targeting regimes, but these discussions of the general strategy were not cast in terms of financial conditions, interest rates or other financial conditions, and in terms of the consequences of policy decisions for the central bank's balance sheet. That was not only not typically part of the discussion of policy targets or general strategy, but not even what was decided on a meeting-by-meeting basis. Typically, the consequences for the balance sheet were considered details of the implementation of policy that the policy committees themselves didn't really have to talk about, let alone specify in advance. People in the central banks concerned with implementation would, of course, be carrying out particular transactions as necessary to achieve these operating targets for short-term nominal interest rates. So, of course, following the crisis, things were very different because the interest rate policy of a number of the leading central banks came to be constrained by an effective lower bound on policy rates. I say effective lower bound, it's often talked about as the zero lower bound. It wasn't necessarily, in most cases, exactly a lower bound of zero, and to some extent it wasn't a lower bound that was a strict limit on what it was feasible to do. It was to a large extent a self-imposed bound on what they thought it was prudent as a level to take short-term nominal interest rates. Nonetheless, these bounds were treated as important constraints that the central banks were not going below, even under circumstances where they felt the need for additional stimulus remained quite strong. This is a picture of the policy rates of several of the leading central banks around the time of the crisis. What you see is at the end of 2008, all of these policy rates fall very sharply. They all, by sometime in the first half of 2009, then reach a level that remains unchanged at least for another year, although in many cases for several years. What that level is different for the different banks. In the case of the ECB, initially they didn't think it was something they could consider doing to go below 1%. Other banks, like the Bank of England, had at that time stopped at a 0.5%, 50 basis points. The Reichsbank went down to 25 basis points. The Federal Reserve went down to a target band between 0 and 25 basis points. But in all of these cases, there was some bound that was rapidly reached. In the case of the crisis, that the banks weren't willing to go below, and so then interest rates, sometimes for very long periods of time, were remaining absolutely fixed. That didn't mean that policy committees stopped discussing monetary policy, though, even though they were not changing their targets for short-term nominal interest rates. Instead, the focus of the meetings of the policy committees shifted mainly to other measures, two in particular, so-called quantitative easing measures, balance sheet expansion, essentially, even though the balance sheet expansion was not in order to implement a different interest rate target. Secondly, forward guidance, meaning statements that the policy committees would decide to make about the outlook for future interest rate policy, even though these statements were not, in this period, connected with changes in the current operating target for short-term nominal interest rates. And the question I think this poses for people working in models of monetary stabilization policy is to what extent this dramatic change in the kind of things that were being discussed in this period mean that we need a quite different conceptual framework for thinking about the nature of monetary stabilization policy and what defines a good monetary stabilization policy, given not all countries are completely beyond the period in which these bounds are relevant, but also for many central banks, the idea that the bound might again become relevant, not simply the next time there's a really major crisis, but perhaps just the next time there's a normal recession is a concern that I think a lot of central banks are having to think about. So to think about how this changes things, I need to talk a little bit about how we tended to understand what central banks were doing in the period right before the crisis. The logic of this flexible inflation targeting regime, as Lars Svensson and others had it called it. And this kind of regime is one that can be given a normative justification, as in fact an optimal policy, in some simple types of models of what monetary stabilization policy does. And I'm going to talk about a normative theory that I've worked on in the past, which discusses what optimal monetary policy would be for an economy where the only sources of inefficiency were assumed to be, on the one hand, the existence of market power and various kinds of tax distortions, and on the other hand, crucially, distortions that would result from wages and or prices not being adjusted instantaneously in response to changing market conditions. And in this kind of analysis, then the role of monetary policy was conceived to be using the instrument of monetary policy to mitigate the distortions resulting from the existence of these nominal rigidities by trying to maintain an environment in which it would be less important for people in the private sector to have to be carefully tracking constantly changing nominal aggregate demand. And so the fact that they weren't constantly updating their prices and or wages would not be creating such large distortions. In order to ask what optimal policy would look like in an environment of that kind, one can describe the optimal policy at more than one level of generality or more than one level of specificity about what's happening. The most general level is what I would call the policy targets level, defining targets that the policy should be trying to achieve, and that could be used to ask whether policy was on track or not in terms of variables that are not directly controlled by the central bank, but that it cares about. In order to decide what optimal policy should look like at that level, one can define a Ramsey policy problem by asking in this environment what the feasible real allocations are, and together with those real allocations, quantities produced and consumed of different goods in the economy, what the associated prices of different goods and the evolution over time of the general price index and the prices of relative prices of different goods could be, that could be consistent with any equilibrium under any possible monetary policy, given the tax distortions, given the market power, given the assumptions about the nominal rigidity. And here I'm particularly talking about an analysis that in its simplest form assumes this Calvo-type staggered price setting that is central to many new Keynesian DSG models and that we've heard about previously. And so one can define a set of conditions that define the feasible paths for the real allocation and for those price variables jointly, for them to be consistent with optimizing price setting by the firms that are setting prices in the economy, and then for purchasing decisions to be being made in response to the evolution of those prices optimally. And one gets a set of first-order conditions then for maximizing the welfare of the representative household in the economy subject to those constraints. You can get something more interpretable out of the form of those first-order conditions by log linearizing them around a steady state with a constant inflation rate, the constant inflation rate being the one that is in fact the one that would be the optimal Ramsey policy in this environment in the absence of stochastic disturbances. And when one log linearizes those first-order conditions, one gets a set of linear equations that imply the linear relationship that's at the center of the slide here, that one can call an optimal target criterion. It's something that one can show this solution to the Ramsey problem would have to satisfy in each period. It's a linear relationship between the inflation rate, a particular measure of the inflation rate that is relevant in the model, a Dixit-Stiglitz price index. The XT variable is an output gap, the percentage difference between a particular measure of aggregate production in the model and a welfare theoretic concept of potential output. It's a combination of a bunch of different types of real disturbances in the model. So there are stochastic variation in productivity, stochastic variation in preferences. There can be stochastic variation in wage markups, stochastic variation in government purchases, in real tax distortions, and so on, that are all going into the definition of this this Y star variable. This condition is a condition that would have to be holding at all points in time if one had the equilibrium that was a second best optimal equilibrium given the feasibility constraints in the model. It also has the property that it's a sufficient condition for that this condition plus the structural equations of the model are sufficient to give a unique non-explosive rational expectations solution, which will in fact be the solution to that Ramsey problem. So it gives an interesting characterization of what outcomes should look like in the solution to the Ramsey problem, and it has the form of a flexible inflation target. So it's a criterion that involves the inflation rate. It implies that this inflation rate over the longer run will have to be equal to a constant because over the longer run, this first difference of the output gap is going to have to be close to zero. At the same time, it implies that in the short run inflation, it isn't optimal for inflation to be constant. There should be justifiable deviations from this long run target rate of inflation associated with non-zero output gaps. And so if there's higher than average growth of output relative to potential, that should be associated with lower than target level of inflation being aimed for by the central bank. If it's a lower rate of output growth than the growth of potential, one should aim for temporarily a somewhat higher rate of inflation. That's one description of optimal policy. To take it more to the level of something the central bank can more directly affect, one wants to ask, well, what are the financial conditions associated with this? In this approach, it's possible to solve for the constraints that define that criteria I just mentioned without looking at the equations in the model that price financial assets, but the model also implies a stochastic pricing kernel for financial assets. Once we have the solutions for aggregate production and for the general price level, This CT is the various exogenous shocks also in the model. One can solve then for what the stochastic pricing kernel should be in that equilibrium, hence how all financial assets are priced. In particular, one can work out what the state contingent evolution of the short-term nominal interest rate should be, and therefore say in any state of the world, given whatever shocks you think are hitting the economy, what the level of interest rate should be. You could also discuss the feedback rules for setting the nominal interest rate as a function of economic developments and ask which ones of those would be consistent with the state contingent evolution that you want in the Ramsey equilibrium. You could ask if different feedback rules would bring about a determinate equilibrium that corresponds to the Ramsey equilibrium. And so on. Taking it to a still more specific level, one can turn to what I would call the implementation level, where you would not just ask, well, what financial conditions do you want to bring about the Ramsey equilibrium, but what does the central bank have to be doing with its balance sheet to do it? Here you adjoin to the previous equations of the model, equations describing the balance sheet of the central bank. It holds assets, it issues monetary liabilities, it's rebating its portfolio earnings to the private sector. If one puts into the model a convenience yield from using these central bank liabilities in transactions, you can derive a demand function for the monetary base, connecting the equilibrium real value of these monetary liabilities to the real volume of activity in the economy, and this interest rate differential, the difference between the policy rate and the interest rate being paid on reserves. The existence of this equilibrium relation now allows you to ask what the central bank has to be doing with one or the other of the two variables that are under its direct control, this MT, the volume of its monetary liabilities, and this ICB, the interest rate that it's paying on its monetary liabilities, specifically the interest rate it's paying on reserves. Those are both directly things the central bank can control in order to get the IT, this policy rate determined in the money markets, to be where it wants it to be. And since we've figured out in the Ramsey equilibrium how the P and the Y and the I should be evolving, that puts a constraint on what the central bank should be doing with one or the other of those other variables to implement the policy. Now, where does this idea of an effective lower bound comes in? This effective lower bound would be a constraint on what the central bank can do with this interest rate paid on its liabilities. A traditional discussion of that would be to assume it's the fact that institutionally the central bank is committed to allow those liabilities to be converted into currency if people want to hold currency, and that currency necessarily has a zero nominal interest rate, and that would make zero the floor. Zero is not necessarily the floor, as we've seen, although I think it puts some limits on what it's feasible to do with that interest rate on reserves. For many central banks, it was considered for prudential reasons that the lower bound on the interest rate on their liabilities might even be higher than zero. The Fed, during the period I was referring to, didn't want even to go quite to zero. But in any event, there would be some lower bound on this. That would be a constraint on what could be done at the implementation level, but that could then imply constraints on the financial conditions that could in fact be realized by any implementation policy, which would go back and put a constraint that could be relevant to the Ramsey problem. In the traditional analysis, it wasn't that the existence of such a constraint was ignored, but it was often the case that we would assume that we were interested in analyzing a case where the stochastic shocks hitting the economy were small enough that the short-term nominal interest rate IT called for to support the Ramsey equilibrium would in fact never be lower than this lower bound. And then that would, if that were going to be true, that would mean we could ignore the implementation constraint in defining the Ramsey problem. We could proceed in the order I described, where you only talk about what's happening to the central bank's balance sheet at the very end, if you need to talk about things at that level of specificity. As I pointed out, experience since 2008 shows that we can't assume any longer that the desired policy would never involve pushing the policy rates low enough to violate this constraint. And so what I want to ask is, well, what changes when we have to assume that sometimes the constraint would be binding? We can go back and use the same approach, though. We can define the Ramsey problem again, but now one is going to have to, at the level of defining the policy targets problem, we're going to have to impose this constraint. The lower bound constraint on the interest on reserves is going to imply a lower bound that certainly can't be lower than that on what can be done with the policy rate, no matter how much central bank liabilities are being expanded and no matter how low the interest on reserves is taken. So that would impose at least this constraint on feasible financial conditions. That in turn can be translated into a constraint on the joint paths of the general price level and real activity, and put into the Ramsey problem. So now you have an additional inequality constraint, but you can again work out the first order conditions. You get a set of Kuhn-Tucker conditions that involve inequalities for the Lagrange multiplier associated with that constraint, complementary slackness conditions. In my work with Goide-Egertsen back in 2003 was the first case where we worked all of this out in a model of this kind. Again, you can log linearize then those first order conditions that describe the Ramsey policy. Again, you can show that you can derive a linear target criterion such that satisfaction of this target criterion involving the evolution of the price level and the output gap is going to be necessary and sufficient for a non-explosive solution to correspond to the Ramsey problem. It has to be generalized, though, relative to that previous description. So the optimal target criterion that we derive then for this more general setup can be most conveniently stated in terms of what we call an output gap adjusted price level. So it's a linear combination of the log of the price level and the output gap with, again, this positive coefficient phi. And what the rule would specify is that this output gap adjusted price level, the central bank should aim to keep that on target at some time-varying target level P star T, if it's possible to do so consistent with the lower bound constraint. So if it's possible to get the output gap adjusted level to equal P star T would be predetermined anytime a policy decision is being made. You would do it unless the zero lower bound doesn't make it possible to hit it. When it's not possible, the policy rate should be kept at the lower bound. It should be taken as low as is feasible or as is considered prudent, even if that involves then undershooting the target P star. Where does the target P star come from? It should be should be adjusted over time according to this adjustment rule, where the adjustment of the target for the price level, the P star, is a function of target shortfalls in the recent past. So it's predetermined each period, and it only requires that you keep track of what your targets have been and what the output gap adjusted price level has turned out to be and the extent to which you're falling short. You don't have to define it in terms of other variables, so it's still relatively simple to keep track of whether policy is conforming to the target or not. If the zero lower bound never binds, those deltas are always zero. The P star will grow at a constant rate, and it's going to be equivalent to the flexible inflation target criterion that we defined before, but this would generalize it. Okay, so is it very different from the previous message? Well, there's an important respect in which this prescription is rather different from the kind of flexible inflation target criteria I mentioned before, because now the optimal target criterion, it involves the price index, it involves this same concept of the output gap, but it's not a criterion that you can verify each time you have to make a policy decision simply by looking at projections for inflation and the output growth over the current period. And checking a criterion which is completely independent of prior history in the way you do that. So instead, the criterion, if you go back to here, the criterion, first of all, is going to involve adjustment of the P star. That's going to depend on history, on whether you were able to satisfy the criteria in the past or not. But even more importantly, it now involves the absolute price level and not the inflation rate going forward. And that means that if you've had target shortfalls, there has to be a commitment to make those shortfalls up. So if you have a target shortfall, you're going to have to be targeting a higher rate of nominal growth than would otherwise be the case. Okay, so I'm about out of time. What if people aren't expecting the policy? So this is what would give you the best equilibrium if people were expecting it at the time the effective lower bound comes to bind. In the situation we were actually in, there wasn't any reason for people to be expecting this kind of subsequent policy, though, because central banks had not been explaining the nature of their policy commitments in those terms. Central banks could say, well, should we behave that way later? If they behave that way later, but people had no reason to expect the history-dependent policy while policy was being constrained, that would, according to our analysis, not actually accomplish anything. And so the question is, was there something central banks could do under that kind of situation? And the answer is there were various kinds of ad hoc changes in policy that were made even though they didn't fit into a framework that people had already understood before the effective lower bound was reached. One type was expanding the monetary base, something you could continue to do. And the question is, does expanding the monetary base, even though it's no longer pushing down short-term nominal interest rates, accomplish anything? One reason to think it might is there was a paper by Alan Auerbach and Maury Obstfeld, I think an important paper published in the AER in 2005 that does a theoretical analysis of the effects of open market purchases of riskless short-term treasury debt in a situation where without those purchases, the existing money supply has driven the nominal interest rate down to zero, and they show that these open market purchases, when you have a zero short-term nominal interest rate, does increase both output and prices, even though it's not affecting interest rates. But something that's important to note about the thought experiment in that paper is that it's not the effect of increasing monetary liabilities during the period while the zero lower bound is binding and leaving intentions for interest rate policy unchanged. It doesn't involve a change in interest rates at the time of the open market operations, but it is implying that people should expect different interest rate policy later, because in their paper, they're assuming that the monetary base is not just increased at the time of this open market operation, but that it's permanently increased. And that implies then a different interest rate policy after the lower bound ceases to bind. In fact, in their paper, this open market operation is mathematically equivalent to the central bank committing to a higher nominal GDP level target. And it's that fact that it in their analysis leads people to expect that after the crisis is over, the central bank will be targeting not just not letting the nominal GDP level permanently fall, but actually a permanently higher nominal GDP level target is what's responsible for the effectiveness of the action. Now you might ask, well, okay, but is that what people should have expected if there were big expansions of central bank liabilities when we did reach the zero lower bound? A problem with that view of what the policies were doing is that there's in fact no obvious reason to think that a central bank that does that is intending to permanently increase the supply of its reserves. This is, for example, what it meant when Japan first instituted quantitative easing back in 2001, in a period when they were at the zero lower bound. Many Western economists argued that what they needed to do was increase their monetary liabilities, even though short-term nominal interest rates were already at zero. You see that they did it. The gray region is the region of the official quantitative easing policy. They did very substantially increase reserves, which is the area in here is expanding like that. The overall monetary base went up by about 75%, but when the quantitative easing period ended in the spring of 2006, they very rapidly took back a lot of those reserves and in fact put the monetary base back on the same trend path it had been on before. So it obviously is feasible to do that. There was no reason why people should have been expecting this was a permanent increase in reserves. And if you ask about what's going on in the case of the U.S. more recently, I mean, we have so far kept the balance sheet large, but the intention is to pay interest rates now on reserves and to control short-term interest rates by varying interest on reserves. In the Auerbach and Obstfeld model, it's assumed there's zero interest on base money. Given zero interest on base money, a permanent increase in the monetary base will be equivalent to a higher nominal GDP target and a higher price level target. That's not true if you intend to raise interest rates on reserves while you have the large base. Another kind of ad hoc policy. Do I have time to say something about forward guidance also? Or? Okay. Another kind of policy that was experimented with was an ad hoc announcement about the outlook for interest rates extending into the future, not part of a previously explained policy rule. If you assume that this was taken to be a credible commitment and that people correctly understand the consequences of that commitment, then a rational expectations analysis would imply that you should get the same equilibrium response as in the rational expectations equilibrium that Goiti and I had calculated, where this kind of policy would be following from the price level targeting rule. But the part about saying a credible commitment and the consequences correctly understood, I think, are important qualifications. The actual experiments we saw were pretty different than what the price level targeting regime would be implying. Central banks weren't really willing to commit to a future policy different than what would seem desirable in the future conditions. They were only offering forecasts about what they currently anticipated that future conditions would warrant. The commitments they were making were mostly date-based rather than outcome-dependent, and that in turn, I think, was an important constraint on their willingness to be more specific about exactly how long the commitment would last and how things were eventually going to play out. Furthermore, the assumption that people should have rational expectations is, I think, a particularly heroic assumption in this case, because we're talking about changing policy some distance into the future, and it's a novel policy so that people don't already understand these consequences from previous experience. Something we know from experimental game theory is that when we ask people to play a game and explain completely the rules of the game to them, but it's for the first time, a game they haven't played before, their ability to reason their way to the Nash equilibrium simply from knowing the rules is limited. Convergence to equilibrium occurs much more closely when you let people play the same game repeatedly and then learn from experience. In this case, expecting the forward guidance to work would not be the case where experience is present. You would be relying on people's ability to deductively conclude what should happen, and I think the evidence is that people are much less good at that. There's also experimental evidence that people's ability to solve dynamic optimization problems through explicit forward planning is quite limited. Can we put that into our analysis of what good monetary policies are? In some recent work, I've shown how DSG modeling of the kind I was referring to before can be extended to, in fact, assume rather than rational expectations that people engage in forward planning only a finite distance into the future. And the consequence of that is that forward guidance does still have stimulative effects, but smaller effects. The effects become smaller than under the rational expectations analysis, particularly in the case of a very long-lasting commitment. The same thing would be true about the Auerbach and Obstfeld policy experiment. If you assume that you can't rely on rational expectations, again, this more realistic analysis would say the stimulative effects would be much less. Does that mean that then committing to the price level targeting regime would also be weakened? And there I think it's important to say that that's not really equivalent to these ad hoc policies. If you assume rational expectations, the ad hoc policies are equivalent to having had a price level targeting regime all along. I think an advantage of an actual price level targeting regime is that people could get experience with it before the crisis come to have an idea of what the central bank's commitment means and how things work under that, and have more desirable stabilizing effects result from that. Thanks. Sorry for going over.